Europe is weak. Europe is lagging behind. Europe is not investable. Surely you have heard some of these statements before. And while we don't have giants like Apple or Nvidia in Europe, we do have many interesting companies that smart investors shouldn't overlook. European giants, AXA, Louis Vuitton, and SAP are not just ordinary stocks. They are pillars of the European economy that influence markets around the world. AXA is one of the largest insurance players in the world. Louis Vuitton dominates the luxury industry, and SAP is a key player in software and IT. In today's video, we look at what's behind their success, what challenges lie ahead, and whether these companies are still attractive investment opportunities. Two of them are now trading below their fair value. Hi investors, this is Chris from 𝗕𝗂𝗶𝗀. None of the information in this video is investment recommendation. Always do your own detailed analysis. First up, a look at Louis Vuitton, the colossus that dominates the world of luxury. This French group owns over 70 prestigious brands, from fashion houses like Louis Vuitton and Dior, to jewelry and watch brands like Bulgari and Tag Heuer, to world-famous wines and champagnes like Moet and Chandon and Dom Pérignon. LVMH is not only synonymous with luxury, but also a symbol of incredible growth and innovation. How have they managed to become the largest luxury goods group in the world, maintain their position as a leader in such a competitive segment, and what is actually behind their success? The company's story is a fascinating success story that spans more than 3 decades. The birth of this global luxury powerhouse began in 1987 when two iconic brands, Louis Vuitton and Moet Hennessy, merged. The move was a brilliant strategic move by Bernard Arnault, who became the richest man in the world for a while thanks to it. His fortune is currently estimated at $255 billion, but LVMH's path has not always been easy. Its success has been due to bold acquisitions and the constant expansion of its portfolio. This has given it control not only of the biggest fashion houses, but also of top wineries, distilleries, and luxury watchmakers. LVMH is a profit-generating machine. This company has a unique business model that guarantees growth even in times of economic uncertainty. This is exactly what we have seen in recent years of all kinds of crises, from COVID to economic decline. The company's shares have appreciated by a staggering 214% from 2020 to 2023. But in the last year, their price has moved significantly away from the peak, giving room for new investors. One share is trading just above $620 today. The company also pays regular dividends, returning value to its investors. With their financial stability and high profits, this is an interesting long-term investment for anyone who believes in the future of luxury. If you like the company, check out 𝗕𝗂𝗶𝗀, where you'll find not only all the data you need on the company, but also its fair price, which is currently below its intrinsic value. Now let's move on to German giant SAP, which is at the heart of the European technology sector. SAP is known as one of the largest providers of business management software in the world. Their systems are used by thousands of companies around the world to manage finance, supply chains, human resources, and other key segments. What makes SAP so special, and why is it such an important player in the global market? SAP's focus on cloud technologies has been fundamental in recent years. It is now investing heavily in moving to cloud platforms. And this change isn't just about technology, it's about streamlining its customers' businesses and offering them flexibility and scalability. This transition is critical to their growth potential and also key to keeping ahead of competitors like Oracle and Microsoft. In 2023, SAP reported annual revenues of over $30 billion, with much of this growth driven by the cloud division. Revenue from cloud solutions grew by more than 20% year-on-year, proving that the transition from traditional on-premise or locally installed solutions to cloud services is not only successful, but key to future growth. The boom in cloud solutions and artificial intelligence has taken the company's stock to new all-time highs, where it now remains. Since 2022, when you could buy one share for $80, its value has increased 174% year-to-date. In addition, SAP has maintained a long-term policy of stable and growing dividends with a current dividend yield of around 1%. For this company, there is no reason for the stock to fall yet, even though its price is currently above its intrinsic value. The technology boom is still not over, and the company continues to grow rapidly. Its business is expected to increase in the coming years. Analysts see it the same way. Now we move on to the last company on our list, and that is AXA, one of the largest insurance and asset management providers in the world. This French company boasts a strong position in insurance and financial services, and its stock is attracting the attention of investors looking for stability and long-term growth. The company manages over EUR 800 billion in assets, and its history is marked by a series of acquisitions that have enabled it to strengthen its market position and expand its service offering. AXA shares have shown stable performance, both in the short and long term. In 2023, AXA reported a 6% year-on-year increase in earnings, underlining its robust business model and ability to adapt to changing market conditions. The valuation of AXA shares is currently appropriate, given their historical performance and future prospects. The PE ratio is around 10, which compares attractively with peers in the insurance sector. According to the Fair Price Index on 𝗕𝗂𝗶𝗎, the stock is currently selling below its fair value. AXA is also known for its stable dividend policy. It currently provides a dividend yield of around 5%, which is attractive. All of these companies are navigating the dynamic European market in an environment full of challenges and opportunities that define the current economy. The European economy is undergoing a transformation in which digitalization, sustainability, and innovation play a key role. Companies that can respond quickly to changing consumer preferences and adapt to technological trends gain a competitive advantage. If you're still undecided about which company might be right for you, you can compare them against each other using Octagon on 𝗕𝗂𝗋. And if you're more interested in the current situation in the European car market, which has been in steep decline for the past few years, you can check out our previous video, where we took a look at how car companies can recover. Good luck with your investments.